Okay, guys, this is for topic 3.3 Money and Banking. It is covering chapter 27 in your books. So, last topic, we talked about the aggregate demand, aggregate supply model. And then the aggregate demand, aggregate supply model is actually going to come back into play with the topic after this one, 3.4 monetary and fiscal policy. But this topic, 3.3, is going to give us a little background so we can figure out monetary and fiscal policy once we get there. So, the key questions for this topic are what is money and how do banks create it? So, we're going to talk about what money is, how it functions in the economy, and the role our banking system plays here in the United States specifically. So, money, the definition of money is anything in society that does these four things. So, it can come in any way, shape, or form, but as long as it serves these four functions: medium of exchange, unit of account, store of value, and standard of deferred payment. If it can serve all of those functions, it's going to be considered money. In the past, I've seen folks leave off function number 4, standard of deferred payment, but your book has it, so we'll talk about it. But that fourth one is really just a combination of the other ones that are already on the list, so it's a little bit redundant, but since your book has it, we'll put it in there. Money typically comes in the form of currency. Currency is a type of money. It just means paper bills and coins. So here in the United States, we've got dollars and we've got cents. That's our currency, and it's also our money. So most countries use a form of currency as their money. But money does not necessarily have to come in the form of currency, right? In older societies, people used to trade in seashells and precious metals like gold and silver. So it doesn't have to come in the form of currency, but most modern economies do have currency. So that first function of money, medium of exchange, I want you to know that is probably the most important function of money in our society, that medium of exchange. So medium of exchange means sellers pretty much will widely accept it as payment for their goods and services. And the reason this is the most important function is because it allows us to trade without having to worry about bartering. So bartering means you trade a good or service for another good or service, and it's really hard to pull off, which we'll talk about a little bit more in a minute. But some kind of creative or different mediums of exchange in different little societies and little economies would be tobacco leaves used to trade back in colonial times. You could use it to buy other stuff, and that was the standard. Tobacco was used to trade for other goods and services in a lot of those early colonies. And then in the U.S. prison system, they're not allowed to have currency, so they get creative to trade for goods and services. It used to be cigarettes were the key prison currency. Now cigarettes aren't allowed in prisons either, so people trade soups, which are just ramen noodles. So I found this cool article. Let's see if NPR will load it. But essentially means ramen noodles are now the prison currency of choice. So it's pretty cool. You can see it functions a lot like currency among inmates in there. So there's an entire informal economy based on ramen. You can tell, one inmate told me, you can tell how good a man is doing financially by how many soups he's got in his locker. 20 soups is pretty good. So as long as it is the standard that most people will accept in a prison system, in a colonial economy, in a modern economy with dollar bills, it's going to serve that function. And that's the most important function of money. The reason it's the most important, again, is because bartering is really hard to pull off. Trade one good or service for another good or service. Because if you're going to barter with somebody, you have to find something that they want when you want to purchase something. That's called the double coincidence of wants, meaning each person has something the other person wants the same amount in order to trade. Versus if everyone just kind of agrees to have a standard currency, you don't have to go about trying to find what McDonald's wants from you every time you want to purchase a Big Mac or something like that. So medium of exchange, really key function of money, helps our economies develop faster and exchange happen more fluidly. I have a video here. This kind of shows the difficulty of the double coincidence of wants. It's just a funny movie clip when Two guys run out of the standard medium of exchange. They try to barter, and you can see it's kind of difficult. So you can pause here, give that a watch under the supplemental video tutorials for topic 3.3. All right, so as the medium of exchange, money can come in many different forms. So the three forms of money are commodity money, commodity-backed, and fiat money. So commodity money means that we have a type of money, it serves those four functions in society, but even if it wasn't the standard medium of exchange, it has intrinsic value beyond that. So the soups in the prison system are an example of commodity money, because even if soups weren't the currency, they're still valuable because you can eat it, right? And in the past, other examples of commodity money would be like gold and silver coins or pieces of gold and silver, even if they're not in coin form, or those tobacco leaves in the colonial era. So if something is a commodity type of money, it is a physical commodity of some sort. Most economies have evolved away from that because it's very inconvenient to have to carry around physical commodities in order to trade for other things, right? Imagine if the rest of the U.S. economy switched to a standard of ramen noodles for pricing. That would be very inconvenient to go to the store and have to carry around a bunch of bags of soups to get other groceries. So after a while, people got tired of carrying around commodities. Most economies switched to commodity-backed money. So this got rid of the issue of having to carry around the physical commodity. There was a government that issued bills, but they had the commodities to back them up. So if you've ever heard the term gold standard, that's an example of commodity-backed money. The US dollar up until 1971 was backed by the gold standard. That means our US dollar bills could be exchanged through the Treasury for some sort of precious metal, gold or silver, a lot of the time. So that kind of gives the money its value. So it's still based on the value of the commodity, but you don't have to carry it around. And then the last type of currency is fiat money or fiat currency. That means there is no intrinsic value behind it. There's nothing backing it up. It is not valuable itself. It is just essentially what the government has decreed will be the currency. And the only thing that really gives its value is people's faith in that currency. So if you ever look at a dollar bill, in fact, if you have one handy now, you'll notice somewhere on there is printed, it says legal tender for all debts, public and private. That is the government decree saying that our dollars have value. So you might have noticed I said that we were on the gold standard until 1971. And that's true. And during that time period, we switched to fiat currency. So fiat currency now, our dollar bills do not have anything backing them up. It is really just green pieces of paper you've got in your wallet. And if everyone tomorrow decided that that wasn't going to be the medium of exchange anymore, dollar bills would be worthless. And many other countries have seen this happen, right? If they have a fiat currency that's not backed by anything, and the government is irresponsible with printing these dollars, people decide that they're worthless. And guess what? They are. You can't buy anything with some hyperinflated currencies. So that's what we use today. That's what most modern economies use, fiat. So this here are some what looks to be U.S. currency. They are U.S. currency. But you can see at the very top, these are actually really old dollars and quarters here. So on this dollar bill, you can see at the very, very top along the border, it says silver certificate right here. So that's back when you could exchange this little dollar for some silver. If you look at a modern dollar, you'll see at the very top in this same spot, it says Federal Reserve Note, which kind of represents that transition from the gold standard and commodity-backed currency to fiat currency. This dollar came from 1957. There's that government decree I was talking about earlier. That's still on the dollar bill today. And down here, this quarter is a 1964 quarter. This is when quarters were actually produced with silver. So modern quarters, they do not have silver in them. it is too expensive to use silver to make quarters, and quarters aren't worth that much anymore. So these older quarters, some people actually collect them and melt them down and use them for the silver if you can find an old quarter back from the 60s. So kind of cool. They look like the stuff you'd find in your wallet, but this is actually a commodity-backed type of money, and this is commodity money because it is the physical silver in there, whereas modern dollars and modern quarters are not. My students always like to ask me too, if you find an old dollar, can you still get silver for it? No. Those have been taken out of circulation, and you can't exchange the old ones for silver anymore, but good try. So, considering we've used both, there's some pluses and minuses to using the original commodity-backed money and commodity money itself, like the gold standard, and the fiat currency we use today. So, the big pluses to commodity money for an economy that's starting out is it links the money to something tangible, right? It's very easy to get a currency up and going if people know they can exchange it for some sort of valuable commodity. And it also can limit inflation, because if you have to have a commodity itself to function as the currency, or you have to have the commodity available to exchange and back it up, the government can't just go crazy printing money, right? The downside to commodity money is that if there's a fluctuation in the price of the commodity itself, that can cause inflation. So, for example, if we were on the gold standard and someone was digging around in Alaska and discovered this huge new deposit of gold, so the supply of gold just goes up really dramatically, basic supply and demand will tell us that the price of gold will go down, and therefore the value of the dollar will go down with it. We'll get some inflation as a result of the commodity price changing. So it's a little bit risky in that sense. There's some macroeconomic risk there. Fiat currency, you don't have that problem. It's not backed by a commodity, so there's not as much risk with the commodity prices causing your currency value to switch. The downside to fiat money is if you have an irresponsible monetary authority responsible for circulating the dollars and controlling your money supply in an economy, if people get greedy, they can just start printing, right? And that's what we see in the countries that suffer from really dramatic hyperinflation, like Venezuela and Zimbabwe and all of that. Because it's fiat currency, they don't need anything to back it up. They can just go crazy and create inflation that way. So, like I said, pluses and minuses to both. Some people say we should go back to the gold standard because they don't trust the Federal Reserve, which is our monetary authority. But some people say, well, there's macroeconomic risk tied to the commodities as well. So pick your poison in terms of what kind of currency you want to use. So interesting stuff. All right, the second function of money, now that we've talked medium of exchange, the most important one to death, is unit of account. So unit of account just means that it gives us this common language to talk about value in. You can think of unit of account as money functioning as a measuring stick, measure the value and the prices of things. And it allows us to keep consistent records, right? Because we know everything is measured in dollars. When I go to the grocery store and I see bananas for 89 cents and some coconut chips for $3, I can get an idea of the relative value of those things because I'm using this consistent measurement to talk about the value of the coconut chips versus the bananas. So it gives us a way to understand value, to talk about the value of items that we're trading, and it also allows us to keep consistent records. So I like this little last question here. Could we use apples as a unit of account? Could that satisfy this function of money? Could we measure the value of everything in apples? Could we keep the value of everything recorded in the number of apples? Could I say that your laptop is worth 7 crates of apples? And the answer is yes. The unit of account function is fairly easy to satisfy as long as there's a consistent way to measure. That's a pretty easy function for money to serve. Third function of money is store of value. So a store of value means that you can hold your wealth over time, and for the most part, it's going to keep its value. So you can preserve your wealth and use it to spend that money later on. It's more convenient than holding on to goods themselves. So if I'm an apple farmer, so this last bullet point on the slides, would apples be a good store of value? No, would be the answer, because apples are going to rot. They're not going to keep for a very long time. So I don't want to store all my wealth, all my value in the form of apples. But as far as dollars and coins go, that's a much better way to store value over time. Now, we say that most currencies, including the US dollar, is not a perfect store of value, because we know the value of a dollar declines over time due to inflation. But for the most part, over short time spans, it does serve this function for the most part. However, there's a lot of alternatives in the US economy. Most people do not store their wealth in terms of actual bills and coins, though I've had some funny stories about students who have heard of people just, putting money in the walls of their house and all that stuff. But most people store their money in a savings account. They have some stocks, some bonds. They own other types of assets like their home. So the store of value function of US currency isn't as important today, because there's all these other ways to store your wealth that's more efficient, but it is still technically a function of money. And then the last one, standard of deferred payment, that I told you was kind of the optional one that your book added in. Standard of deferred payment just means that you can purchase something now and pay for it later. So we measure loans in dollars, and allows us to have access to things that we don't necessarily have the money for right now. So in order for something to be the standard of deferred payment, you kind of have to combine the previous ideas. 1, medium of exchange, and then also 3 that we talked about, store of value. So if we know that most people will accept money as payment, and we know money generally stores its value over time, that allows you to kind of enter into this loan market where you can purchase some things today and pay for them later on, like using a credit card or taking out student loans. All right, so those are the 4 functions of money. Now economists like to discuss how we measure all of the money that's floating around in the US economy. So if we were to count up all the dollars and cents, how much money would we have? And the question is actually a little bit more complicated than just figuring out how many coins were minted and dollars were printed, because a lot of us don't actually keep all of our cash. If I were to ask you how much money you have, right, you might think about the balance in your checking account. Even though you don't have that in physical bills, you can spend it as if it's real money. And it is real money in the sense of the 4 functions. You can spend it the same way. It stores value, unit of account, and all that good stuff. So we have to get a little creative in defining what is the money supply, or the amount of money that's out there. And so we have 2 definitions of the money supply, M1 and M2. So M1 is the simpler definition of the money supply. It's currency, so it's all the bills and coins that are in people's pockets and wallets and walls of their houses, It also consists of demand deposits or checkable deposits. That's just a way of saying the balance in your checking account. And then traveler's checks. So traveler's checks are kind of dated. They're a very small part of the money supply now, because we have so many alternatives to how to spend money abroad, but they're still around. They are still technically part of M1, but don't be surprised if you don't see traveler's checks as part of the M1 definition, because they're just becoming obsolete. People can use credit and debit cards a lot more safely as they travel, but they are technically part of M1. So when we add up all the currency out in circulation, all the balances in everyone's checking accounts, and all of the traveler's checks, that's how we get the total amount M1. And we say M1 consists of very liquid types of money. So liquidity just means how quickly can you exchange it for the medium of exchange, right? How quickly can I turn this into cold hard cash? And these are very easy, right? It doesn't get more liquid than the currency itself. Checking deposits, fairly easy to turn the balance in your checking account into cash, right? Just go to an ATM, write a check. get anything that way. So this is the first definition of the money supply. It's the older definition. More typically, we use M2, which is just expanding it. So M2 consists of everything in M1. So those currencies, demand deposits, and traveler's checks are still a part of M2, but we add 3 extra categories. We include savings account deposits, money market mutual funds, and small time deposits, or a certificate of deposit, or a CD for short. So a certificate of deposit, as long as they're not very long, it's a way you can make a deposit, but you agree not to touch it for a set amount of time. But so long as it's not like a multi-year CD, it's considered a small time deposit and still fairly liquid. You'll get that money back quickly if you buy a certificate of deposit with a bank. So it's the broader definition. It includes more stuff. The reason we switch from M1 to M2 is because of the addition of more modern banking technologies, primarily ATM machines. It's very easy to access your checking account, and nowadays it's also very easy to pull money out of your savings account. So if we are going to count checking account balances as money in the economy, it makes sense to consider the savings accounts as well as these other 2 categories, CDs and money market mutual funds. So this is the bigger measure of the money supply and includes more stuff, and this is the one that is more closely monitored today. All right, so here is an example of the money supply. This is measured in billions of dollars. So if I were to add up all the currency and the checking deposits, as you can see here, I didn't even include traveler's checks in this little example here. We get 2,989 measured in billions of dollars. So that's like saying M1 is about $2.9 trillion, about $3 trillion, really. And then if we were to calculate M2, we're going to start with M1, and then we're going to add in 3 more categories. Those money market mutual funds, the small time deposits, and then the biggest addition is going to be savings. People have a lot more money in savings. So the M2 money supply is always going to be bigger than M1 because M1 is a part of M2. So M2 is going to be 11.8 billion or so dollars. So that's our definition of money. We've defined the money supply in the economy. So now we're going to move on to that second key question, which is how do banks create money? So contrary to popular belief, or maybe not popular belief, but belief before anyone's taken an economics class before, your bank doesn't just hold on to your money for you, right? If you have a checking account or savings account, when you put your money there, your bank is not just serving as a safe with some nice people at the front. They are using your money to do business. And so what banks are is they are financial intermediaries. So that means they connect people with money and looking to save it to people who need money and are looking to borrow it. So banks are depository institutions, which means they take your deposits and instead of just storing it in the back in a big safe, they take your deposits and they use it to make loans to other people. So most of your money in your account is not actually sitting in the back of your local Wells Fargo or Regions or whatever bank. It's probably out on loan to somebody else, surprisingly enough. So what happens when you deposit your money? Your bank does one of 2 things with it. When you make your deposit, they use it to make a loan. That's their primary use. Like I said, banks aren't there just to store your money for you. They are looking to use your money to make some more money. So make loans to people like student loans, mortgages, a car loan, all that good stuff. Or they can set your money aside, in which case we call it a reserve. So if the bank keeps some of your deposit in their own safe, or they could put it in a safe at the Federal Reserve, which is our central bank. They're like a bank for banks. So they can keep it in their own safe, or they can keep your deposit with the Fed. Those are called reserves. So in the U.S., we have a fractional reserve banking system, which means when banks get deposits from customers like you and me, they only keep a fraction of it on reserve, usually about 10%, and they lend out about 90% of it. So if you were to deposit $100 in your bank, they would probably set aside $10 of it and then use the other $90 to make someone a mortgage loan or a car loan or something like that. And banks want to lend out as much of your deposits as possible because that's how they make their money. When they take that $90 and they use it to make a loan to someone else, if they make good loans to trustworthy people, they're going to pay back that $90 plus interest, and that's how the bank makes their money. So banks don't like holding on to reserves because there's that high opportunity cost. There's that high next best alternative. That money could be out working for the bank and earning some interest. So that's how fractional reserve banking works. So knowing that banks want to lend as much as they can to make their money, why do they even bother holding any reserves, right? I said they normally set about 10% aside. Well, there's two reasons. One is they want to accommodate their customer withdrawals. So it would be very embarrassing for your bank if you tried to go access money in your checking account and you said, hey, I'd like to withdraw some cash from my account, and they said, ooh, sorry, we don't have that right now. That would be bad news for them because you're going to go tell all your other friends that this bank is in trouble, that they're not giving you your money back, they're going to lose you as a customer, and it could cause a panic altogether. So the bank is always going to keep enough set aside every day and try to anticipate how much their customers are going to withdraw. Because they don't want that to happen. They don't want to not have enough money to accommodate the withdrawals. And then the other reason they keep 10% set aside is because there is a requirement called the Required Reserve Ratio, or little RR for short, that the Federal Reserve sets. So like I said earlier, the Federal Reserve is the central bank of the United States. We'll talk about them more in topic 3.4. But essentially, they do have a lot of important jobs, but one of them is setting regulations on banks. And one of those is including this reserve requirement. They say, hey, banks, don't lend everything out. That's too risky. You need to set aside at least this amount, which is called the reserve ratio. It's almost always 10% for most big banks. So that's generally just to prevent what I have here in the orange, which is a bank run. So a bank run occurs when a bunch of people who have made deposits with a bank all try to take their money out at the same time. And so if we were to all run on the banks, everyone were to show up at the same time and try to get their money, the bank's not going to have enough money because they're only keeping 10% on reserve at any given point in time. And so if everybody shows up at the same time trying to pull money out of their accounts, they're going to have to tell them, sorry, I don't have it. And then more people will show up in a panic after a rumor gets started that the bank might be in trouble. They don't have your money. And then if enough people show up and start pulling their money out, now the bank will essentially go out of business. They can't make any loans. They've lost all this money. Maybe the loans they made weren't good, and that's why they didn't have the money in the first place. So bank runs are bad news. They're not so common anymore today, but they were a big issue back in the late 1920s in the United States. So this is just a little graphic of fractional reserve banking. The bank gets their money from depositors, and then they turn most of it into loans, set some aside as reserves. So there is some question on whether or not the reserve requirement is necessary. A couple slides ago, I said banks on their own have an incentive to make sure they can accommodate the customer withdrawals. They don't want a bank run any more than their customers do. Because a bank run means the bank has to go out of business and people lose a lot of money. So they're always going to try to have on their own enough money on hand to prevent that. But bank runs were quite frequent prior to the Great Depression and at the start of the Great Depression, back in the late 1920s, early 1930s. And the reason is because these bank runs were quite frequent. So part of the New Deal was this government program called Federal Deposit Insurance Corporation, FDIC. And so you might notice next time you go to your bank, you'll probably see a sign somewhere that says member FDIC or on your bank's website. And what it means is that bank pays into this government program that essentially insures your deposits. So up to $250,000, if your bank fails, if there is a bank run, this federal program will make sure you get your money back. So the idea was to increase bank stability, prevent bank runs, because even if there was a rumor going around that a bank had made some bad loans, people wouldn't panic as much because they knew that if push came to shove, there was this federal program in place that would insure their money as long as they didn't have more than $250,000 with that one bank. So it worked for the most part. Before FDIC, there were thousands of bank closures in the years leading up to the Great Depression and at the start of the Great Depression. Now they're fairly rare. So it definitely did its job in terms of decreasing bank runs and increasing stability in the banking system. But FDIC also had the unintended consequence of leading to something called moral hazard. So moral hazard is this condition where if you do not have to bear the consequences of a risk, you're more likely to be risky. So think about this from the bank's perspective. They know that their customers aren't going to run on the banks. And the reason they know that is because there's this great federal program in place. So if you're a bank and you're making loans, you can decide to lend to people who are very safe. And if you lend to someone who's very safe, very trustworthy, very high income, you can't charge them a lot of interest on that loan, right? But if you make a risky loan, then you can charge more interest. More risk means more reward. This is a risky individual that you're lending to. So if they pay off the loan, you can charge them a higher interest rate, but there's always the risk that they will default. They just won't be able to pay you back at all and you lose your money, right? So high risk means high reward, low risk means low reward in terms of interest for the banks. Now, if I know that a bank run isn't going to happen anyways, banks are more likely to make those risky loans. That's the issue of moral hazard. And some people even blame part of the 2008 crisis on FDIC because banks didn't have this incentive to protect themselves against risk and prevent a bank run. They were more willing to make these risky loans. So definitely some pluses and minuses to FDIC. All right. So we're going to talk a little bit about the process of how banks create money, but I'm just going to recap where we're at so far. So remember, our definition of the money supply includes both currency, so the physical bills and coins, but also the balance you see in your checking account. We call those demand deposits or checkable deposits. We have a fractional reserve banking system, meaning that the bank can lend out a fraction of their deposits, most of it, and that banks connect borrowers and savers. We call them financial intermediaries. So when I talk about banks and how they create money, they don't actually have a printer back there. They don't mint coins or print bills. They create money by making loans. So we'll talk a little bit about that process. The best way to kind of examine this process is by thinking about the bank's balance sheet. And now if I have any accounting students in here, don't worry, I'm not going to make you balance a balance sheet on your test. You're welcome. We're going to look at a very simplified version of a balance sheet. So a balance sheet is just a financial tool. It allows you to track both assets and liabilities. So assets are items of value that the bank owns or is owed, and then liabilities is money that is owed to other people. Okay, so it's debt to others. It's also sometimes called a T account because there's two sides, one for the assets, one for the liabilities. And then the whole point of a balance sheet is the assets and the liabilities have to kind of balance out on both sides. So that's the name balance sheet comes from. So for a bank, there are three types of assets that they can have. So it's money that they've lent out. That's money they're expecting to come back. Securities. So sometimes banks will own bonds or treasury bills or U.S. Treasury securities. That all means the same thing. It's just a type of financial asset that banks can purchase. And also reserves. That's the money that from their depositors that they have back in the vault. So those are all their assets. Those are all the things of value that they own. The liabilities, on the other hand, the debt they owe, is typically the deposits. So if I go deposit $100 at Wells Fargo, they now owe me $100, right? It's in my account. That's a liability to my bank. And then the other thing that goes on the liability side is the net worth. So it's the assets minus the liabilities, and you can kind of think about it as the value that is owed to the shareholders of the bank. Sometimes it's called the owner's equity or the bank's capital. So here is an example of a balance sheet. So here I've got a bank, maybe they've got $5 million out in loans, they've got $4 million worth of government securities, and about $2 million set aside on reserve. Their deposits, that's what their customers have deposited with them on the liability side, that's $10 million. And because they have more on the asset side than the liability side, their net worth is going to be $1 million. So I'm just going to jump over here to my good old, where is my pen? There we go. Boop. There we go. Sketchpad here. So the way I got this net worth here is we just added up the asset side. So if you add all of this up, 5 plus 4 plus 2, that's going to be $11 million on this side. And we got $10 million in deposits. So this net worth here is going to be assets, the 11 million minus the 10 million. That's how we get this guy, 1 million. So you want a bank with a positive net worth. You definitely don't want one with negative net worth. That means the bank owes more money than they have in value. But as you can see on this balance sheet, if we were to add up all of the assets on this side and all of the liabilities, the 10 million plus the 1 million in deposits, both sides are going to equal 11 million, and they balance. So, like I said, I'm not going to make you mess around with one of these on the test. It's definitely a simplified version of the real thing, but it kind of gives you an idea of the process and how your bank transforms a deposit. So, here's how this happens. So, if you were to go to your bank and you were to deposit $1,000, now the bank has $1,000 in reserves. Okay? Let's suppose that the required reserve ratio is 10%. So what they can do is they can set aside $100. So that's still an asset to them. And then they can, that reserve is now an asset to them. And then they can lend out $900, 90% of that $1,000 deposit. Now, if you go look at your checking account online, the balance there is still going to read $1,000, right? So that is money. You can spend it, you can access it, you can go to an ATM and take out that $1,000 anytime you want. But also, the bank has made someone a loan for $900. So we just took an initial $1,000 deposit and we turned it into $1,900 floating around because you still have your $1,000 and someone else has this new $900 loan. So that is how banks create money. Now, I know it seems a little weird, it seems a little unstable, but so long as everyone doesn't run on the banks and try to take out their deposits all at once, this is kind of the super cool way that banks control our money supply. They expand it through this fractional reserve system. So the process can continue on. So let's say that $900 loan goes to a student named Alex. Alex uses that $900 to pay Valencia College some tuition. Valencia College is going to take that $900 payment and put it into its bank account. And then guess what its bank is going to do? They're going to set aside 10%, $90, and lend out another $810. So if we were to think about this in terms of the balance sheet, we had this first top one, the College Kid Bank, right? You went and deposited your $1,000, so you can see that on the liability side for the College Kid Bank. The bank set aside 10% on reserve, $100, and lent out the other $900 to Alex. Alex then deposited or paid that money to Valencia College. And now if you drop down to this bottom balance sheet, the college bank will deposit that $900 with the big bank. So you can see liabilities went up by $900. The bank will take that deposit, set aside 10% on reserve, $90, and lend out $810. So this process can continue on and on and on. So when someone gets that $810 loan, and then they deposit that with a bank, and then the bank sets aside $81, then we'll get a loan of $729. And then it'll go on and on and on. So really what we can have here, and this is the same table here, is after that first iteration we had $1,900 in deposits, and then we had another $810. So this goes up to what? $2,710, and on. My money supply keeps growing, right? We started with $1,000, but as banks continue to take those deposits, set aside 10%, and lend it out again, my money supply grows. And in fact, that initial $1,000 could grow to a total impact on the money supply of $1,000 or $10,000. So that's pretty incredible. So there's actually a shortcut. Instead of trying to add along the way, kind of like I am in the columns over here, this would take a very long time. 900 plus 810 plus 729, and on and on and on. There's this shortcut called the money multiplier equation. So the money multiplier tells me how quickly banks multiply the money supply, right? It has two really big assumptions built into it. First of all, that all currency is deposited into banks. So when you go and get a loan from a bank, right, and in my scenario there, Alex got $900 and paid that $900 to Valencia, we assumed all of that $900 went into the bank. Not everyone deposits the full amount, right? You might take some of that money and keep it in cash and stick it in your pocket instead. In which case, the money supply wouldn't grow as much because the bank wouldn't have as much to lend out. And also, we assume banks don't hold any excess reserves. We assume the bank is going to keep lending out 90% every time it can, which is not necessarily true. Maybe if the bank expects a lot of withdrawals that day, they won't lend out 90%. But the money multiplier realistically is a maximum size. So that means after that $1,000 deposit, the maximum that could be in the money supply would be this $10,000. But in reality, it's probably a little bit smaller. So here's essentially how we would use it. This is our symbol for money multiplier. Don't get scared by this superscript. It doesn't mean anything mathematical. You don't have to do anything. This is just a label that basically means money multiplier. And then it's 1 divided by little rr, which is our reserve ratio. So in this case here, our reserve ratio was 10%. So we would divide this by 0.10. So don't forget, put this reserve ratio in decimal form. You have to put it in decimal form for this to work. If you put a 10 down here, that's not going to work. If you type that into a calculator, you will get 10. And that's how my deposit of $1,000 grew to be $10,000. So that's pretty cool. Don't get this confused with the rule of 70. Rule of 70, you don't convert your percent to decimals, but that's a totally different rule for economic growth. This one is a legitimate equation, so you have to convert your percents to decimals, whereas rule of 70 was kind of a shortcut. So a kind of cool thing about the reserve requirement, if the Fed were to increase the reserve requirement to, say, 20%, they say, hey, banks, you can only lend out 80% of all your deposits. If we were to calculate the money multiplier then, MM would be 1 over 0.20. That would be, if you type that into your calculator, you should get 5. So now banks can only grow deposits to be 5 times their original size. So if we bumped up this reserve requirement to 20% instead of 10%, that same $1,000 would only turn into a total of $5,000 instead of $10,000. So the Federal Reserve has quite a bit of power here to change that reserve requirement and grow the money supply or shrink the money supply. If they want to decrease the amount of money that the banks are creating, they should up this reserve ratio. If they want to expand the money supply and grow the amount of loans banks can make, they can lower that reserve ratio to, say, 5% or 0% in some cases. So, kind of cool. That's all I have for money and banking. Make sure to check out the practice questions and application questions, and let me know if you have any questions.